Good afternoon from BI Norwegian Business School. We are here to present our buy recommendation for Vestas with a target price of 1,480 Danish kroner and a 23% upside. We believe the market has underappreciated the following three key catalysts. Vestas' technological moat, which unlocks a higher pricing potential, its offshore expansion maximizing shareholder returns, and its unique position to capitalize on the renewable transition. Vestas is a global leader producing premium wind turbines along with service solutions. Its business is divided into three segments: onshore, offshore, and services. By the end of 2020, Vestas had a solid order backlog, 3 times its annual revenues. Vestas distinguishes itself by having the longest vertically integrated value chain, covering everything from turbine design to plant optimization. Operating in the wind energy industry, Vestas is by default contributing to a more sustainable future. Vestas is also outperforming its peers in many dimensions of each of the E, S, and G. With the environment, Vestas traces all the waste generated by its turbine and its ecological impact at each individual site versus competitors who only evaluate impact per product line. Regarding the social aspect, Vestas is one of the safest wind turbine manufacturers in the industry, with no reported fatalities in 2020 compared to 3 fatalities reported by Siemens Gamesa. Vestas' governance structure represents the highest Scandinavian standard. With an experienced board and management team, we're confident that the company will deliver best value to its shareholders. With a combined sustainability score of 3.2 out of 4, we found only minor improvement areas and believe Vestas' superior ESG performance will continue to attract ESG-conscious investors. Erlend will now elaborate more on our investment thesis.
We believe the market is undervaluing Vestas' technological moat. Vestas consistently spends more on R&D than its closest competitor, Siemens Gamesa. This creates a positive feedback loop. Higher R&D spending leads to superior technology, which in turn leads to premium pricing. The cycle continues as premium pricing allows Vestas to afford the additional R&D. This cements Vestas' long-term competitive advantage. Vestas' supply chain is moving towards a digital future. With 60% identical components across onshore and offshore turbines and industrial-scale 3D printing, the company has global flexibility. Processing over 100 billion signals per day with predictive analytics, Vestas increases turbine uptime and accurately forecasts energy output. It is also creating utility-scale hybrid solutions. Additionally, investors have overlooked the potential from Vestas' offshore expansion. Offshore is set to become a $1 trillion industry by 2040, and Vestas has already made its move. It recently launched the world's largest wind turbine of 15 megawatts, enough to power 20,000 homes. The turbine is designed with standardized onshore components, and after the recent acquisition of MHI Vestas, the company is now realizing strong synergies from unified onshore and offshore manufacturing. Due to its corrosive environment, offshore turbines require more maintenance. Compared to onshore, where service accounts for 40% of Vestas' operating profit, offshore accounts for close to 60%. Vestas is the only player with unparalleled service and a global service infrastructure, which can therefore exploit this. With these advantages, Vestas is well positioned for a 24% offshore CAGR between 2020 and 2026. We further believe investors have underestimated Vestas' unique position to capitalize on the renewable transition. Trillions are pouring in from governments and corporations to support the sustainable transition. Renewables are set to become 3/4 of the electricity mix by 2050, with wind alone capturing 32% of it. This is because of onshore wind's larger capacity and low levelized cost of electricity. Offshore is also expected to become cheaper than solar over the next decade. Controlling 25% of the market, Vestas' global leadership will be the key to unlocking this energy transition. It outperforms peers through its superior efficiency, highest nominal capacity both onshore and offshore, and best-in-class service. So, with these factors in mind, we believe Vestas is best positioned to capture renewable investments. Sara will now show you how our investment thesis is incorporated in the financial projections.
We project Vestas's revenues to grow at a CAGR of 11% over the next 6 years. Growth will be driven by an increase in deliveries and gigawatts under service. This is a result of increased electrification, green investments, Vestas's tech-enabled services, and its offshore expansion. We also expect Vestas to maintain stable prices, which will further support the revenue growth. We forecast costs to recover quickly after the pandemic, increasing gross margin to 16% in 2026. This is driven by cost reductions coming from supply chain automation, post-acquisition synergies, and input mix optimization. As a result, Vestas will improve its EBITDA margin, reaching 15% in 2026. We expect Vestas to retain its margin leadership due to industry-leading technology. Historically, Vestas has obtained superior profitability compared to peers. We predict this to continue and result in favorable shareholder returns, with EPS growing at 20% CAGR between 2020 and 2026. We therefore expect Vestas to increase dividend payout, reaching 4.8 euros in 2026. We project CapEx to rise as the company expands into offshore. However, this is offset by an increase in operating profitability. With an interest coverage ratio 3.6 times higher than peers, Vestas has solid debt capacity that can readily support its offshore journey. We issue a buy recommendation for Vestas with a target price based on a multi-stage DCF analysis. This model befits Vestas's innovative company profile, allowing us to account for both its aggressive and its stable future growth phase. With cost of capital estimated at 7.1% and terminal growth rate of 3%, we arrive at a target price of 1,480 Danish kroners, which represents a 23% upside. On a positive note, we do see a potential upside for a conservative terminal growth based on the anticipated renewable boom and Vestas's favorable market position. This will result in further share price appreciation far beyond our target price, as seen in the sensitivity analysis. Joe will now expand upon our relative valuation.
Now, to supplement our DCF, we conducted a relative valuation where we compared Vestas to 4 different peer groups: non-Chinese and Chinese wind manufacturers, solar manufacturers, and other green tech companies. We apply a small premium of 10% to Vestas's EV to EBITDA multiple to reflect Vestas's superior ESG and SDG positions compared to its peers, reaching a 2021 EV to EBITDA multiple of 24. This implies a price of 1,507 Danish kroner, a 26% upside, which confirms our buy recommendation. We expect a potential repricing of Vestas, as we believe it should trade at multiples closer to broader green tech companies because of its superior technological leadership. We also conducted a bull and bear case analysis. In our bull case, we determined a price of 1,840 Danish kroner, a 53% upside, in which the company fully realizes all synergies between their onshore and offshore segments. Our bear case indicates an 11% drop from its current price, but we believe this is highly unlikely. We also tested the sensitivity of our key metrics with the Monte Carlo simulation. We varied WACC, terminal growth rate, megawatts delivered, onshore and offshore selling price, and costs of goods sold. 65% of the scenarios support our buy recommendation, yielding a share price more than 10% above the current price. We identified post-acquisition integration and innovation risk as the 2 greatest risks. Post-acquisition risk can be mitigated by pre-acquisition insight and unified production, and innovation risk can be mitigated through high R&D spending and product flexibility. The other risks were either low probability or low impact. We therefore restate our buy recommendation based on Vestas's technological moat, its offshore expansion, and its ability to capitalize on the renewable transition. For investors looking for a renewable jewel, Vestas is a win-win. Thank you. I will now take your questions.
Thank you. Judges, please turn on your video. As a reminder, stay muted unless you are asking a question. I will start time as soon as the first judge utters the first word. Time will end at 10 minutes. Feel free to begin.
Thank you so much for your presentation. May I ask you a quick question on the market positioning? So you talked about Siemens Gamesa and you talked about Chinese competitors. As you showed on your slides, Vestas is more exposed to onshore than offshore, and Siemens Gamesa actually has a very good market position in the offshore wind. Can you walk me through and help me explain how do you think this gap will narrow further, and how do you see Vestas actually taking market share or not taking market share in the offshore wind? Thank you.
So I can take that one. First of all, they just acquired EMEA, which gives them the offshore benefits. And they just recently launched a 15 megawatt turbine, which is actually the largest turbine that exists on the market today. In addition, Vestas has a superior service segment, and we expect 60% of offshore value to come from their service segment. So with superior service segment and the world's largest offshore turbine, we expect Vestas to actually gain market share and become market leader in the offshore segment.
Yes, and if I can add on to that, one thing that is very important to mention is that Vestas actually has a very high R&D spending. It invests 60% more in R&D than its competitors, and it has done it successfully. If you're looking at its return on invested capital, you would see that it's around 2.2 times higher than its peers. And this is a testament to its efficient allocation. And this is what will narrow the technology, which will widen the technology gap between Vestas and its competitors even further.
Thank you.
Great. So team, thank you very much for presenting and also doing the detailed analysis as well. My question is around, so your analysis is based on the assumption that Vestas obviously produces really high-end solutions and products and they charge premium pricing, right? Have you looked at how sort of alternative suppliers or cheaper suppliers from Asia and other regions would impact the long-term, your CAGR expectations and valuation, and also the buy recommendation as well?
Yeah, I can take that. So if you go to the China slide. So basically, there's three global producers, Vestas, SGE, and GE, that operate over the entire world outside of China. And then in China, we see Chinese OEMs dominating. They have a very low upfront cost model. We have very cheap turbines, but they don't last as long as these other global OEMs. They're slightly lower quality and they require more service. So what we're seeing is that in the West, they prefer turbine suppliers that give them lower LCOE, which is the levelized cost of electricity over the entire lifetime of the project. And that's what they deliver in the West. Whereas in China, they deliver lower upfront cost, but higher cost over the lifetime. And we really see over time that the Chinese market is adapting more to the Western model. And that's why we think that there's a higher chance that Western companies will go into China than Chinese companies coming out into the rest of the world. And this is especially true because infrastructure, people are quite critical to Chinese companies owning infrastructure that's considered critical in Western companies.
Could I ask on the valuation in terms of the additional 10% that went into the valuation for its ESG approach? Do you think that's a reasonable level to put in? Look, when you look at global investors, investors from the US across emerging markets, do you think that they will pay that valuation premium?
Yeah, so if we go to the ESG side, the reason why we have chosen to put 10% ESG premium is in order to match the ESG impact on the DCF, the same ESG impact that the ESG has on our DCF in our relative valuation. And basically what we can see is that this 10% actually matches the impact by having higher market share, which is materializing in the revenue as Vestas gets more and more investments. It lowers its risk and it gives gives tax benefits as well. And we do believe that investors are going to be looking at these ESG premiums and will pay higher for that, especially with things like the EU taxonomy coming up online and similar investments.
Okay, can you go back to the slide on ESG and under the social part? Have you come across any disadvantages for wind power generation?
Sure, I could speak to that. So one of the factors in which Vestas has indicated that it could do better is the percentage of female employees that it currently employs. Part of Vestas's commitment is to have 30% females employed by 2030. So right now they're a little bit below industry standard, but they're quickly moving to catch up.
Are there any disadvantages on the part of the consumer or the inhabited areas where these turbines are planted or set?
Sure, I could speak to that as well. One of the things that Vestas does is for every turbine that they put into the ground, they do a site-specific life cycle assessment, which means that they assess the impact of how it's going to affect wildlife, how it's going to affect fisheries, how it's going to produce sound. And they do everything that they could do to mitigate those impacts in each specific location. Vestas's competitors only do a life cycle assessment for each product, which means they don't have the same level of specificity.
Okay, thank you.
What would you like to see them doing on acquisitions, and is their level of debt too low, given all the opportunities that you see for them? Should they be taking advantage of them more?
Yeah, so right now there are no beneficial acquisitions as we can see. However, we do expect them to take on more debt in the future, and that is also calculated or included in our WACC calculations, where we have accounted for a 10% debt level going forward.
Yeah, I think just to add on to that. So right now, as you mentioned, there's not a lot of acquisitions available in the market. It's a very consolidated market right now. But we do expect them to keep picking up key technologies. So they're not really going for inorganic growth, but just picking up key technologies. And that's sort of what we've seen in the past, that they're going to complement this technology lead and really make sure they get this premium going forward. And when you compare them to peers, as you mentioned, they do have this debt capacity to easily acquire these companies compared to peers which are loss-making right now and cannot really afford this.
When you think about the first quarter, it was quite tough for them, especially on the onshore side. Can you please comment on that, and what do you think happens to the order backlog? And also if you can talk about the regional split and where exactly you see that backlog to come in, if you expect that.
Sure, so if we go to the technology risk first, to that slide, Sophia. Yeah, you can see here that basically they've had some problems during the second quarter of 2020 where they had extraordinary warranties. However, what is very important to mention is that they came out of the year which had COVID-19, and plus they had extraordinary warranties, and they came out with a very high net income margin and profitability. And when you compare them to all their competitors, you would actually see that the competitors are actually loss-making right now. And we believe that considering that they went out from these two crises with positive profits is a testament to their effective management of the company. And then someone else can take the order backlog.
Yeah, I can take that, Sarah. So what we're seeing in terms of warranties and extraordinarities and sort of problems on the horizon, I don't think there's any specific region this is located to. The products are quite homogeneous. Obviously, extreme environments make it more likely. However, going forward, we have estimated at 3% warranties, which is up from around 2% previously, and down from 2020, where it obviously spiked to 4.7%. So we are seeing that with this increased product cycles that are much faster these last few years compared to previously, there's going to be a few more hiccups, and we see this across the entire industry.
So relative to other types of renewable energy sort of growth how fast was, you know, wind energy generation, for example, compared to how fast was it growing compared to solar, for example, power generated energy?
Sure. Sophie, can you take us to the levelized cost of electricity comparison with wind against the other renewables? Yeah, great. So right now we see that onshore wind has the absolute lowest levelized cost of electricity compared to other renewable energy products. So because
Time. Thank you, BI Norwegian Business School.